Hi, everyone, and welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Let's get started.
President Trump just named his pick for the next chair of the Federal Reserve. Kevin Warsh served on the Board of Governors from 2006 to 2011.
We knew this day was coming, we just didn't know when. Silver and gold got absolutely clobbered.
Elon Musk's SpaceX has now acquired his startup, xAI, largest merger in history that is gearing up for a massive IPO.
All right, questions?
The first thing we'll talk about is our new Fed chair, or I guess the nominated Fed chair, Warsh, which used to be what people told me to do with my hands when I lived back up in the Northeast. But Warsh is out, Warsh is in and Powell is out. That's going to be a fun name to say over the next few years. What is the market thinking here? So I think, initially there were some real concerns around the independence of the Fed chair. President Trump basically nominating somebody that was going to do his bidding. And, in reading kind of the initial reactions about Warsh, I don't necessarily think that that's how the market has digested it initially. I think there may be a little bit of a turn of opinion, though. Warsh has historically been a little bit more of a hawkish tone in the Fed Reserve. And so, initially I think the market's thinking, okay, well, somebody that's hawkish probably isn't set up to just, do the bidding of the president. And so the Fed's independence will continue to remain. And I think that may have been called into question a little bit over the last handful of days. Still quite a bit of time. We've got until I think it's, kind of early to mid-May before there's actually a change in the Fed chair. And, going back to, okay, well, is this a lame duck Fed session? Is the Fed going to do anything? Is any kind of rate cut on the table? Or, a lame duck Fed session means that basically no rate cuts. The market is pricing in right now that there are not going to be really any substantial changes to the interest rate environment in the near term. And I think they're also kind of starting to price in, well, if Warsh is a little bit more hawkish than maybe cuts in the longer term going out at 6 months to a year, maybe a little bit lower probability of sign there as well. So we're getting to see a yield curve that is fairly flat in the front end and then upward sloping in the long end. Nothing necessarily wrong with that. I think from a market preference perspective, stability is the first priority. Certainty is the first priority. They'll adapt to the level of rates, but stability is something that is always valued in the market versus uncertainty. Markets, as we said a number of times before, do not like uncertainty. It is rejected in almost every potential place. For our part, we don't bet on interest rate movements. We don't, hedge. We don't take long duration plays. We do think we take a diversified approach when it comes to our interest rate exposure. So for portfolios that do have a little bit more equity, sometimes it makes sense to have that interest rate exposure in there to dampen volatility. So far this year, though, fixed income, or at least treasuries, have not been that great of a diversifier. They're, effectively flat so far this year. So when equities have sold off, they've protected in terms of not losing value. Typically, you'd want them to protect in terms of appreciating and gaining value in those sell-offs. So still TBD on that, but we're definitely, kind of early stages in terms of experiencing this bout of market volatility, which I think really kind of only started to rear its head, a week or so ago. January was actually a pretty solid month. Markets were up pretty much across the board. Different participation than we're used to seeing. So this January, called January effect rally, was more of a classic textbook academic style January rally where you saw small and mid caps doing quite well. Large caps, momentum stocks did okay in January, but really kind of the smaller cap stocks really kind of led the month. That has not necessarily changed in terms of the relative rankings, but during this market sell-off, the mega cap names, the technology names are really kind of what's taking the brunt of the market's volatility. But before we get into that, let's talk about commodities. We ended 2025 with gold and silver appreciating substantially, moving up and almost kind of creating that asymptotic ramp up in prices. I think gold was at or just above 5,000, and I don't know the price of silver, but I think silver was up over 300% last year. big moves for those precious metals. And, for the most part of the year in 2025, gold was really kind of the story. Gold had, been outperforming every asset class that we really track. And then had actually gotten to a point where over, a number of years, kind of going back like 10 or so years, you actually were starting to see better returns in the gold commodity than you were seeing in equities, right? Which is very uncommon. Typically, they're a little bit more neck and neck, or gold, kind of lags over long periods of time. Equities with substantially higher volatility, but last year kind of started to give gold an edge, which was really kind of calling into question traditional asset allocation methodologies. Silver really came on strong in the last, kind of half of the year, and really even kind of the last couple of months of the year. But really kind of, you saw a lot of people writing about, well, when gold appreciates and moves a certain amount, silver just has this, kind of elastic reaction where at some point that elasticity gets stretched and it needs to rebound and catch up to some extent, which I kind of get that trade. But so far this year, the opposite is true. We've seen a number of commodities experience significant volatility. Gold and gold and silver, having some pretty substantial sell-offs. Again, selling off from a very high altitude. So think about it as, if you're in an airplane, you're cruising along at 30,000 feet, everything's kind of smooth. You experience some turbulence. The pilot has to drop the plane really quickly to 25,000 feet. You're still a long way from the ground, but that drop from 30,000, 25,000 felt pretty violent. I think that was the case as well with gold and with silver last week during the correction. We saw it coming down. Gold was down about 9-10% in one day. That's a big move for an asset class. Silver down 27% in one day. And so I think, one of the things that we come back to is, risk-adjusted return, diversification. Store of value is a good thing to think about with gold. If we, put the glove on the other hand, if we said, the S&P 500 was down 10% in a day last week, it would be a panic-driven sell-off, right? So that would be a huge move for broad-based equities. So that is a pretty substantial move with gold, but just understand that gold is a single commodity, not a broad basket of securities. So that size of a move doesn't mean as much to kind of broad market health as it would be if it was a kind of broad basket of equities. I think a lot of times, people will talk about, equities and gold as kind of interchangeable. They're just separate asset classes, but equities obviously much more diversified because you own quite a few different securities when you own a basket of equities, and there's a lot more return drivers in that basket. A couple other things on the commodity side. Obviously got quite chilly down here in Texas. Everybody was wrapping their pipes and double wrapping their pipes and wrapping their plants and their flowers and bringing everything in the garage last week. Not a fun experience. We ultimately didn't get really any snow down here in Houston, although they were calling for it. But that cold front swept across the country, and we saw natural gas prices spike up quite a bit for a very short period of time. I think they've retrenched a little bit. But again, just kind of a reminder that, commodities, while they are, diversifiers in some ways, and they do help protect against certain portfolio events, notably unexpected inflation, commodities can experience significant volatility, especially over short periods of time and when we're looking at the spot prices. What does that mean from an investment perspective? Well, as an investor, we do tend to prefer being long the companies or the equities that produce those commodities, given that they can turn the commodity, which is tends to be fairly volatile and demand and supply driven, to something that they can create cash flows out of and then return that to shareholders. So when I think about gold, or when I think about natural gas or energy producers, I tend to want to be long the producers of those economies, of those commodities, the companies that are able to pull those things out of the ground, refine them in some way, and then turn them into a sellable product. So when we think about diversification in a portfolio, again, we typically come back to commodities. We like that exposure a little bit better through the equity producers of those commodities. On the other hand, those producers, they'll give you some inflation protection. It's not as lockstep as pure commodities, but when we build portfolios, that tends to be how we look at the problem. So let's switch gears. Given that we're talking about equities, let's talk about what's going on in the tech world. Notably the Mag 7, which I think Apple's still part of the Mag 7. Apple's holding up quite well, but a couple other stocks in there. Microsoft saw a big markdown last week, or a big drop in its stock price. I'm thinking, markdown's more kind of your private markets terminology, but the stock price in Microsoft dropped a good bit last week. Google had a good quarter. Earnings came out yesterday afternoon. The market is still, rejecting those earnings, and Google's down a few percent, at least in the open this morning. So, good fundamental results. Looking backward are not carrying the day when it comes to tech stocks. It's really about what's going to happen in the near term. Call it 6 months, 12 months, 2 to 3 years out. And so again, seeing a lot of volatility there, and really kind of trying to dig into what is driving that volatility, because again, earnings and cash flows are still really robust. And I think it's a couple different things, and would really be hard to put your finger on exactly what specific thing is driving these sell-offs, because there's a lot of things happening at the same time. So we'll talk about a couple. Number one, I think, is an interesting news story. Whether it's really impactful in the short term would be what we saw over the weekend, which is just this story around Claudebot, which is kind of a slang term for taking basically a really simple computer, turning it into your own personal AI agent, and then giving it access to some of your personal information, logins to sites like messaging apps or email, or some people even have even given it access to their DoorDash subscription or their DoorDash account, so that the agent can say, oh, well, it's lunchtime, I've already ordered you lunch, it's on the way, it's going to show up in 10 to 15 minutes. So really kind of creating that digital assistant to actually do stuff and know you very personally. I think what we saw over the weekend was that setting that up, the cost of setting that up was fairly low. The hardware cost to do that was fairly low, and actually kind of creating that software, downloading that software, installing it on a computer. A lot of people were using Mac Minis, which again is a very affordable personal computer. The barriers to do that were fairly low. Now there's always a privacy concern, and one of the theses that we've talked about on the show before, which I've been following for a number of years, is individuals will tend to prefer, or at least the generation that we live in now, they do tend to be fairly open to exchanging privacy and freedoms for convenience. We've seen that in a number of different trades that have played out over the last decade. This, I think, is a trade that will probably continue to play out as well. And giving up some of your privacies, giving your login and credentials to what you would call a personal digital assistant, similar to what you would do with a personal human assistant. I think that's something that people will start doing, but it is something that I think needs to be done with extreme caution. Obviously, if you give anybody, whether it's a digital assistant or a personal assistant, access to anything personal that could be used to create emails on your behalf, exchange money, make purchases, buy services, you need a fair bit of trust, right? So what we saw over the weekend was, yes, that can be done. Could it be done safely? No, I don't think we've seen that yet, right? But I would expect that comes at some point, in the future, call it the next, 2 to 3 to 4 years, depending on how much trust and how much security the individual needs. Now, why does that matter? I think what the market is looking at there is, okay, the barrier to recreate software and to recreate software services continues to seem to come down, right? The trust side of things, completely different issue, but the ability to, create software without any real, kind of hardcore software expertise, I think that bar continues to drop. Now, I think the big question what the market is struggling with is the individuals and the companies in the market that have the greatest skills in software. Are those skills still valued? Are they going to be something that can be multiplied with this additional assistance of artificial intelligence? Or is it something where those skills are devalued and the artificial intelligence just consumes that type of skill set, right? So that, I think, is a question that is still being digested. Obviously, over the last couple of weeks, the market is saying, well, we're a little more concerned that those skills are just not as defensible. The moat as a software as a service company is becoming shallower and more narrow. And so I think that's kind of what you're seeing in the marketplace. One of the other things going on in this particular dynamic is just the fundamentals of the companies that have been selling off. So, Mag 7, those are good examples to look at, but there are also companies that are outside the Mag 7 that are seeing pressure right now. We could talk about multiples. Obviously, everybody's known the multiples on those stocks have been considerably above average for a period of time, spanning more than just a couple months, right? We're talking about a couple years. Those stocks have been expensive, run a little bit hot, and they've continued to do so. And the market has not really gained, too much of it, or has not had too much of a concern about the level of those valuations. They've hit some extreme levels. They've backed off a little bit. They've hit some extremes. They've backed off again, again and again. And we're seeing a little bit of that today. Now, what is different this time? And I think that's, always a dangerous question, right? Is saying it's different this time around. But I will point out a couple differences versus last year or versus the year before that when we saw some volatility in those stocks. And that really has to do with the nature of the business as it relates to AI and the amount of capital expenditures that, have been known to be taking place in the future, but I think are starting to hit home. We got a preview of that last year with Oracle. Oracle had to raise a substantial amount of debt to fund its CapEx plans and its spending plans to build out, data centers, buy the hardware for data centers. What we saw with Oracle is the market did not like that. Number one, because they don't like when equity companies raise substantial amount of debt because it brings that kind of equity risk higher. So you have a higher discount factor. But also it creates this waiting game where, the market now has that company on a clock. When are the revenues going to show up for those capital expenditures that you said you were going to make? And now we can see you have made the CapEx, you have made the expenditures. We're waiting for those revenues to come in, and the market becomes quite impatient, right? We've also seen Google raise significant funds through debt offerings to fund effectively, some of the same type of projects, to build out data centers, to build and continue to improve their artificial intelligence, their ability to serve clients in that area. It is probably goes without saying, but when Google raised its capital through debt kind of towards the end of last year, it was not met with the same apprehension from the market, mainly because Google's balance sheet was much, much stronger. After they raised debt, I think it was in the, kind of $25 to $50 billion range. They still had enough cash on the balance sheet to pay off that debt, right? So that's a little bit of leverage increase to a company with a really robust and strong balance sheet and also really robust and strong cash flows. Very different situation, or at least as far as it goes last year. This year, what you're seeing is a little bit more apprehension by the market. Google had its earnings came out last night. This morning, the market is definitely backing away from Google. Google again reiterated its plans to continue to spend on AI and to kind of build out those capabilities. And I think that's being met with some resistance, right? So the balance sheet of these technology companies is changing, and it seems like it's changing fairly rapidly to, from being, almost no leverage to being, somewhat levered, or in some cases highly levered, and also in a very asset-light company could potentially become a little bit more asset heavy. Now, when these data centers are planned and are built out, a lot of times they are tried to be, structured off balance sheet. So maybe it doesn't, tie up the balance sheet assets as much, but does create leasing requirements, right? It creates interest service if you're using debt. So the balance sheet of these companies is in flux to some extent, and I think that the market is trying to digest, okay, where are these balance sheets going to land? Is this going to be a temporary blip and then become asset light again and debt light companies, or is this something that it's a structural change where technology companies are also becoming infrastructure companies? Infrastructure as a business tends to yield a much lower multiple on earnings, on revenues than a technology company would. Not everything is negative, right? We've been talking a lot about some things that the market is concerned with, is kind of really backing away from. One thing that we are hearing a lot of excitement and positive buzz about is this SpaceX-xAI IPO news story that has continued to gain traction, gain attention, and also morph over the last months and even over the last couple of days. SpaceX, obviously everybody knows SpaceX is a household name, right? They do rockets. xAI, a little bit less of a household name, but that is the entity that owns the X platform, formerly known as Twitter. Also, the Grok AI system that is kind of the brains behind the Elon Musk ecosystem. of AI, right? And we've heard the name Colossus, right, is kind of the AI, technology or the AI asset that Grok and xAI have built. So recently announced, hasn't actually transacted yet, SpaceX will acquire xAI. And the terms of that deal, I would say, are still probably being fleshed out. But what's been announced is that xAI will be valued at $250 million, consistent with their last equity raise, which actually just closed very, very recently. And then SpaceX will be valued at $1 trillion, the combined entity being $1.25 trillion. So that's a pretty big number. A handful of years ago, that would be very eye-popping. Today, it seems like, a $1 trillion company, you've got so many out there now that it doesn't really, have the same weight that it used to. But to me, that's still a pretty big number. It's a private company. It's not even publicly traded yet. With the rumor, again, this isn't, certain yet, the rumor that they will try to IPO that combined entity sometime this year. When they IPO, their goal is to IPO at $1.5 trillion or higher. Now, that brings up a number of interesting things. Number one, if you like technology and you're just interested in the renaissance of space and the renaissance of defense, I think SpaceX is just a really interesting story to follow, just what they've been able to do technologically and also what they've been able to do in terms of bringing the cost of putting things in space down by orders of magnitude versus anything that we've ever been able to do in history. The sleeper side of SpaceX is Starlink, which is actually the cash cow of SpaceX. I've been a Starlink customer before. It's a really interesting service. I've had really good results with it when I've used it, and it works pretty much anywhere. So that's an interesting angle that, does not get a lot of press, but that's really where SpaceX derives a lot of its, cash flow. And Starlink, as far as I can see, we don't have a lot of publicly available information on that particular business, but it does seem to be a cash flow positive business, but still growing very rapidly, launching satellites up into space on a very regular basis and also continuing to grow their subscribers. On the other hand, the satellite launch business is really kind of the more notable side of things, but that's definitely not what drives net cash flow today for SpaceX, possibly at some point in the future. The other side of the IPO, which brings some things into question, and probably our clients, we have a number of clients that have invested pre-IPO into SpaceX and into API, but the ones that have not are probably trying to think about, okay, when is this going to become part of my portfolio? When am I going to participate in the successes of these two entities of the new space renaissance industry? And so I was digging. I saw actually Bloomberg did a nice article on this, but I was digging around and trying to see, okay, well, we use a lot of ETFs. We use a lot of funds in our business. We're not really stock pickers. And so, part of what we do is we need to know when those equities are going to be included into the things that we invest in, which would be ETFs, in some cases mutual funds, but mostly ETFs, some index strategies. And so, there have not been a lot of IPOs lately. And so I think how they get included into these vehicles is probably a little bit of a knowledge base that needs some dusting off. So just to kind of recap, most ETFs, if they're passive, they track an index. And so they will only buy stocks that are on that index. They try to track it very closely. And so if a stock is added to the index, they try to buy it right away, at the same time, if possible, but to do so with very good liquidity. So they're not not losing a lot of money on the transaction charge. Keep that in mind. What really matters for an IPO for investors that invest through funds, and this is mostly passive funds, but even in some active funds that are very benchmark centric, is when that new stock is added to an index. Now, there's a couple big indexes out there. I'll just talk about the S&P 500 and the NASDAQ. To be included on the S&P 500, a number of things have to happen based on their current rules. You have to have a certain number of days of trading, which means day one is probably not an option based on their current rules to be included in the S&P 500. So a SpaceX IPO at $1.5 trillion does not mean just because of that company's size, it'll show up on the S&P 500. Likewise, NASDAQ has some rules. They are more, we'll call those fast track rules. You still need some trading history. So again, day one, you would likely not see SpaceX on the NASDAQ in the triple Qs. That matters because when an IPO happens, a lot of people are talking about the IPO pop, right? Do you get something on that first day or the first few days? and that's part of the allure of investing into IPOs. With indexed funds, you typically do not receive that IPO pop. You definitely don't get exposure pre-market, and likely your post-market exposure is going to be after the noise has kind of died down. Now, does that benefit or does that hurt shareholders? That is a very case-by-case basis. If you're looking at an IPO that has a substantial pop, a lot of times if you try to buy that IPO on day one, if you're not a pre-IPO investor, you buy after the pop. Very, very unlikely for you to buy before an IPO pops. And so you end up paying the highest price of the day. And if subsequent days continue to trade higher, you benefit. If subsequent days cool off a little bit, you kind of fall behind as a single stock buyer. You kind of skip over that volatility if you're investing through ETFs or through mutual funds, and you kind of you'll invest more after that IPO kind of quiets down a little bit. And there's some good reasons behind that, but I think likely there'll be some pressure from the kind of SpaceX, from Elon Musk and his his team to, I'll say, bend the rules or modify the rules for this, call it, historical event. The SpaceX IPO, if it comes out at 1.5 trillion, would be one of the biggest wealth unlocking events that we've seen in this investor's lifetime. And so to have that particular entity excluded from these major indexes that are supposed to capture the entire, kind of the biggest companies traded in the U.S., you'll likely see some pressure to try to bend those rules or loosen those rules for a special case. The good news is there is some flexibility. S&P that's managed by a committee, right? So they do have some decision-making influence. They can make exceptions from time to time, so they may decide to do that in this case. But that'll be something that we probably don't know until much later this year, and probably not until maybe a month or so before the SpaceX IPO. So first, we need an announcement date for that IPO, an official announcement date, and then we'll need to see what the indexes do. So just one last thing before we close up here. A lot of things coming at us, right? Commodities moving, things that we thought, gold store of value, showing some volatility. So how do we handle this in our portfolios, and how should you be thinking about it with your own financial assets if you haven't trusted them to Avidian? So what do we do here, right? How do we navigate this? Number one is we understand that this is, not the first time that we've experienced volatility, and it always helps to start with a really good plan. And that plan, number one, needs to understand a time horizon. So what we like to do is, we know markets are going to have volatility. We want to turn volatility into our friend, right? You remember the quote, the enemy of your enemy is your friend, right? So volatility is the enemy of the stock market. I don't know if that translates into what I'm trying to talk about, but we want to make volatility our friend. And the one way you do that is you really have a great understanding of your time horizon as an investor. That means that monies that that you're going to need over the next 6 months, the next 12 months, even up to the next 2 to 3 years, you understand that need in a high level of granularity if possible. And also you communicate that with your financial planner, with your financial advisor, or you manage that through your own investment process. And those assets are in something that is fairly secure, so the certainty of those dollars are going to be very high, and there's the odds that you are not able to meet your own financial obligations in the near term is very, very low, right? And we'd like to think about that as a 0% probability, but obviously we can never get anything down to zero. But we want to keep that probability that you can't meet your near-term obligations as low as possible. What that allows us to do is it allows us to identify where we can take risk and where we do have a longer term investment horizon. So second line of defense is diversification. You can't build a diversified portfolio that invests in a number of different risky assets if you don't understand your time horizon. Once you understand that time horizon, then you start to think about, okay, where can I grow my capital? I don't want to place all my eggs in one basket. Diversification is something that, I think has, again, a knowledge base that's probably needs a little bit of dust knocked off of it, because we've seen the Mag 7 just be the driver of market returns for a number of years now. It's been very easy to kind of let diversification take a back seat. What we're seeing so far this year, and you could even say towards the end of last year, is a situation where some stuff is not working well, but other stuff is actually working quite well. When I look at our portfolios today, our models, our small cap stocks are still up year to date. Large cap stocks, momentum stocks are flat, maybe even slightly down, right? So there is always an opportunity to make money for our clients when we do it in a diversified way. And there's always going to be things that are going well. There's always going to be things that are going poorly. And so we use diversification as an advantage, and we use volatility as an advantage. A couple things that we did last year we talked about. When we get volatility, we, again, as a tool, we use it to harvest losses. We have not seen a significant market sell-off. This is not a Liberation Day event yet. And so those opportunities to harvest losses have not come up, but we'll be continuing to watch that. And the last thing on diversification is for your longer-term liabilities, things that you're going to have to spend on, but that are going to be kind of continued spending needs for 5 years, 10 years out. You may want to think about some ability to hedge those expenditures to the extent that you can understand them for inflation. Think about healthcare costs, and maybe there's some assets that you can use to hedge against those costs, energy costs, housing costs, right? Those are all things where you have to spend on those assets in the future, but there are also places where you can invest in those assets to hedge against that future inflation rate. And so we also build that into how we look at portfolios, and that's part of kind of your total financial plan here at Avidian Wealth Solutions. That's about it for today. I hope you all have enjoyed it. If you want to come have a conversation about how these things may impact your portfolio, or just chat with a financial advisor, come check us out at avidianwealth.com.